Hi, Mutual of Omaha gave me this slide presentation that I thought I'd share with you. It's titled Peak 65 because it is describing what they call a new paradigm. And although I don't like using words that don't spell the same way that they sound, I think that it is a good indication of what is happening right now. Because back in 1959, there was more babies born in that year. In fact, one every 9 seconds that are just turning 65 right now. And that is a real shift in our whole society, in that the peak of all of these baby boomers are now hitting retirement age. So what we're going to do it in this video is discuss that and how society is changing, as well as how a reverse mortgage might be implemented into any financial plan. But first, of course, a good old disclaimer, so you're welcome to stop the video and read as much of it as you like. So by 2030, all baby boomers will have turned 65 or older. And then in 4 years later, we're going to see another flip there because the first time in history, there's going to be more people age 65 and older than there will be age 18 and below. So what does that mean for us as society, and where does the shift happen to be? Because, of course, that is dramatically different than what it was before. So there's going to be some concerns for financial planning in the future, and what does that look like? So this video says a lot. It shows us here that in 1900 there were only 3 million people over age 65, and by 2022 there were 58 million. So, and then when you look at the 85 plus, that really is a big change because, of course, people weren't living that long back in 1900. Not many people lived to be 85 plus, but here we are in 2022 with 6.7 million people living to be 85 plus. Now, with medical advances and such happening right now, because we have much better medical care and better focus on our diet than people did back in 1900, people are living a lot longer. And of course, our attitude of retiring and dying at age 65 just doesn't apply anymore. So how is things are going to be changing, and how is that going to look in 2040? And how are we going to be able to fund all of the entitlement programs that are taking care of the senior citizen population? So it's a tough question. So longevity is the big disruptor here. We all grew up with the idea that we're going to uh, get a job, have a pension, have some Social Security, retire at age 65, and live happily ever after with a home that's owned free and clear. But generally speaking, as a society, that idea of pensions no longer really applies. We haven't saved enough for our retirement, and we haven't utilized the 401ks that are fully available to us. So as a society, we haven't saved enough money, and we're living longer. The combination of those things is a little bit scary. Now, we also have healthcare. Medicare doesn't cover everything. A lot of people haven't gotten the supplemental coverage, and Medicare doesn't cover for everything. There's lots of in-home care companies we see popping up, and I think we're going to see more of that to be able to fill in the gaps of things that are not covered under Medicare. Now, even if we own our house free and clear, we still have expenses inflation is becoming a huge issue, where taxes are going up, cost of utilities is going up, food is going up, and we didn't save enough for those expenses. So even if we did own our house free and clear, it's creating a financial stress. So what are we going to do about that? So the transformation is going to be quite dramatic over the next 10 plus years, because we're all living a little bit longer, and with medical advances, and we're a lot more healthy. People start thinking about the difference between living a lifestyle and living with the money that they do have and being able to bounce their last check before they die, versus on the other end of the spectrum, some people want to be able to live and leave as much as they can to their heirs. But in the big picture, people are thinking more of older age, meaning closer to an 80 rather than a 60, which was the previous thought process. So how are we going to deal with this change in society over the next decade or two, with people living longer and probably spending more money that they in their older age than what they ever did have in the past? So the big question in retirement planning, of course, is making that change from accumulating savings in your life to distributing them later on after retirement. And as a society, we have really savings crisis, which is turning into an income crisis because, as we said earlier, and as you know, people haven't saved up enough for retirement to be able to supplement their income for a longer lifetime. This $80 trillion wealth transfer that they're referring to here is talking about in the next 30 to 40 years. Men don't live as longer as women do, so you can see $80 trillion going to be transferred from men to women who are going to outlive their spouse. That's pretty significant when you think about it, because women are going to be in control of all of this money in the soon near future. Now, the most ignored asset in many financial plans is the primary residence, which can be filled with the HECM loan, which is available for people that are 62 plus in their primary residence. And right now, we've got approximately $13 trillion worth of equity sitting there with senior citizens. A good financial plan might be able to create multiple income streams. And of course, you've got Social Security, you've got savings, but what about the equity in the property? That could be an excellent income stream for somebody. When with a HECM loan, you can set this up to have monthly payments for life for a certain number of years. You can create lump sums to be drawn out at a certain period of time on a line of credit. But this home equity can be used to on health related concerns and elder care. You know, I think many of us know that 70% of us did not purchase any long-term care insurance, and those long-term care facilities are not covered under Medicare. So what are we going to do? What about emergencies in the future? You know, we could all look easily in the past and see what emergencies we had in the past, but not planning for any emergencies in the future just seems a little short-sighted. And so many of us have run into situations where people didn't plan for things in the future and ended up being a burden on their children. But if you were able to tap into the equity in their home and not be a burden on the children, it would be able to be a better long financial plan than ignoring it in the first place. So another question is, how are HECM loans, how can they be implemented into an overall financial plan? So of course, these have to be on primary residence, but a HECM can be used to pay off any current mortgage and eliminate any monthly obligations for principal and interest payments for the borrower. You have, hopefully there could be enough equity there that a line of credit can be established and they'd be able to access this cash tax-free, because this is borrowed money. It's not considered income, so it does not have to be considered income. And also, and something at the end of the year, you do not receive a 1098 statement unless, of course, you happen to make a voluntary payment towards the HECM loan. So HECM is good in that respect. You can use the available funds to help pay for long-term healthcare needs that many of us, like I said earlier, 70% of us haven't been able to have the foresight to buy any long-term care insurance. So this, you have a little bit of a savings buffer to be able to pay for something like that. And again, you have an emergency fund to be able to take care of things that might pop up in the future that are just unforeseen. You can have this money available for your spouse to be able to take care of any gaps in income. I just recently ran across a couple where he had some pensions that were allowing them to live quite well, but in the event of his death, those pensions would go away and her income would be severely impacted. So if they had a HECM loan, which they got, now that monthly obligation for the principal and interest on the primary residence is no longer having to be serviced with the income that she did have, which led them to be able to live a little bit more comfortably. Other uses for the HECM is to be able to convert some living spaces for aging in place and caregiving. You can use these funds to cover the expenses in doing a Roth conversion from a traditional IRA into a Roth. Social Security delay, income bridge strategy. You can use this, perhaps you don't want to collect Social Security immediately, delay it to a future point in time, but you need that income. Go ahead and use the HECM to bridge that income gap and be able to collect at a later date. You can use it as a buffer account to mitigate any sequence of returns risk. We all know that investments go up and down in price. And if you use the HECM line of credit as a source of income during those down years, you can help mitigate those risks. Housing costs, deferred maintenance, or of course, final move, which is a nice way of saying funeral expenses. But I should say, our income is always subject to inflation, and people more and more, food costs is going up, utilities are going up, taxes are going up. Meanwhile, our income and certainly the increases on the COLA expenses with Social Security is insufficient to cover for that. Here's a sequence of return risk illustration that shows how using a HECM early as part of a financial plan and being able to use the HECM in those down years to supplement income over the lifespan really helps preserve a portfolio. I'm not going to go into it too much and crunch numbers here. If you'd like, just go ahead and pause the video at this point and you can take a look at these yourself. Now, there's a couple of very important differences between a HECM line of credit and a HELOC, and I think that most people are very familiar with the HELOC, and that is, in this illustration here, you can get a $200,000 line of credit, and at some point in the future, it goes away. But also with a HELOC, you have monthly obligations, monthly expenses that people may or may not be able to qualify for because they're now at a lower income than they were in the past, and they may not even be able to qualify for the HELOC where they are able to do this with a HECM. Another aspect of the HECM too is that the HECM can never be taken away, frozen, or reduced, because keep in mind that this is a government loan and it is always going to be there. A good analogy in thinking about a HECM line of credit is much like a credit card. If you can use a credit card and you were going to get a credit card with a $200,000 limit, of course you can borrow up to that $200,000 and you can pay it back just like on a HELOC. But with the HECM, that is the rate that you're able to borrow always increases at the same rate as what you would be accumulating on your unpaid balance. So as time goes by, your ability to borrow goes up and it can never be taken away from you. So to create the HECM at an earlier point in life and to allow it to grow only strengthens the financial position of the borrower so that they have more funds available to them later in life. This is another good slide about how the HECM compares to the HELOC. And as you can see, the HELOC is stagnant. You get a line of credit, it stays at that rate, and it might be called and due and payable. It might be taken away from you. But the HECM line of credit is always going to be there, cannot be taken away, cannot be reduced, and it's always going to grow at the same rate as what is being charged on the unpaid balance on the accumulated interest. So even if the housing value goes down, this HECM line of credit is going to continue to go up. And that's where this mortgage insurance premium is going to come in handy, because keep in mind, it's not on the slide, but this is a non-recourse loan. So the property is what's responsible for the repayment of the loan, not the borrowers themselves. So in the instance that it ever gets upside down, especially because you have the ability to borrow on it at such a great rate in the future, and the property values over time might go down on a periodic basis, you're never responsible for any of the unpaid balance that is over and above the value of the property. So how does that look like as far as a scenario? Here's a scenario here. We have Joe 72 and Connie 70, and they're living in their house, and he's got $2,500 as far as he's taking in his required distributions, and Social Security income of another, for a total of about $5,100. And then Connie has Social Security of $2,400 and a pension of $1,800 for a total of $42. Home value of 1.25, and they have no mortgage on it, but they have a pretty good nest egg of 550. But their concerns is that they do not have any long-term care insurance, and they have $150,000 of life insurance, but they are concerned about running out of money and whether the surviving spouse of the two of them will have, as far as income is concerned, after they take a hit off of the deceased spouse's income loss. So the solution on this one is to set up a HECM loan with a growing line of credit to protect the portfolio. They're going to create a line of credit of $376,000 that will grow to approximately $825,000 in 10 years. Of course, that depends upon what interest rates do in the next 10 years, assuming that they're going to be doing and getting a adjustable rate loan. So this is going to create a buffer account and provide for an extra bucket of money that they can pull from. It also secures the home for the surviving spouse, because now they're not going to have that, well, excuse me, they will have that extra money to be able to pull from in the future for any gaps in income that's caused by the loss of a deceased spouse. It improves the liquidity, because now they're able to tap into this home equity that they do have in the event of any emergencies in the future. Now, of course, there's the inflation hedge and any payment shocks. We all see what's happening with inflation right now, and taxes are going up, food is going up, gasoline's going up. And as time goes by, who knows how much worse it's going to get. But at least preparing for it now, you're able to see the worst case in the future. You're going to be prepared for it. Okay, here's another quick scenario here. You got Bill 74, K 65. They live in their home. They have pension income coming in. She's got some moderate Social Security income. They've got a little bit of a balance on their savings. Their home value is worth a bit more than what their existing mortgage is, and they have 8 years remaining. But the problem here and concerns is that Bill has some health issues. They have no long-term care. So in the case that Bill was to move on, Kay would be left with the mortgage payment and servicing that principal and interest that is not much less than what her total Social Security is. Now, granted, we don't know here in this exact if this pension is going to survive Bill's death, and she just does get some survivor benefits from the Social Security, but it doesn't leave much room for any emergencies, and it doesn't protect that portfolio that might just get used up in any emergency. So how can this resolve? So the solution to this is really rather easy. We just create a HECM that's going to pay off that existing mortgage and give them a line of credit of approximately $102,000 that is going to grow into approximately $333,000 in 15 years, so that she has a little bit of a buffer asset as time goes by. assuming that she is going to outlive him. And they're also going to save that remaining 8 years of principal and interest payments. So, which would be 152,000, which is now turned that into cash flow into her pocket rather than servicing that debt. It secures the home for the surviving spouse and gives a little bit of a gap income if need be able to draw on that line of credit. The results is that it improves liquidity for the house and helps preserve the existing savings. If you have any scenarios you want to run past me or have any questions, just feel free to reach out, and I will put together any scenarios or answer any questions you might have. I think this is a greatly misunderstood product that is the time has come, and if we start thinking about this as a financial product rather than a mortgage, it really changes the dynamic of the conversation and creates a much more favorable environment for this to be understood.